Unless you're doing all cash, or like I mentioned, you have done enough budgeting to factor in even the worst rate hike we can expect. And the major reason I'm talking about here is the death cross timing that we're going into right now for housing market. Hey guys, welcome back to the channel. So for last week, we know that US have announced a 0.75% rate hike, which means we will probably follow suit come July. And of course, the biggest question on everyone's mind is how is the real estate market doing right now with so many hikes so far and more to come in the future. So what we're going to do today is jump into stats across different major cities and look at what the housing market is doing so far. And then next talk about the idea of real estate death cross that I believe we're in currently, and what you should be doing if you're a first-time home buyer or thinking about buying another property. Now, as always, if you haven't already, make sure you follow us on our Facebook and also comment, like, and share our video if you like what we're talking about today. Now, without further ado, let's jump into today's video. Alright, so let's first look at some stats, and here I'll be mainly talking about Toronto, Ottawa, Vancouver, and Montreal. So starting with Toronto and pulling data from TREP since December 2021 all the way up to May 2022, we can see that the real estate was still ramping up across all property types for first 3 months of the year. Both 416 and 905 area codes sees a massive slowdown in terms of completed sales for the last 2 months. However, we can see clearly that 905 drop in average price is way more than 416. If we compare peak average sale to May's average, 905 dropped double digit for detached and townhome, while 416 dropped half of that. Condo is down 3% for 905 and barely moved for 416. Now keep in mind, average price, these kind of data can be skewed by whether we are selling more big or smaller houses at that particular month. But overall, the trend is very much in line to what we were saying back in April when we did the real estate outlook and looking at past history of whenever we go through big interest rate hikes or policy changes, what happens to the real estate market. And in there, we concluded based on past history, condos usually don't see too much price fluctuation. They stay relatively resistant to price drops. It is usually detached and sometimes maybe townhome that gets hit much harder. Now in there, we also mentioned that if there was ever going to be any adjustment, work from home areas, which is the outer range of the Toronto core, which we've seen the biggest spike in price for the last 2 years, will see a much larger adjustment. This is also applicable to regions in Vancouver like Langley or Maple Ridge, as we'll see later on. Now moving on, let's look at Ottawa. Now for Ottawa, I don't have too much detailed stat unlike I can find on Toronto on TREP. So if you have a good website that shows Ottawa stats in detail, do let me know in the comment down below so I can use it in the future. Now inventory in May increased by 18%, which is 5% over a 5-year average. Price also see a slight drop of -2%, but inventory does remain relatively low for now. Sale to list is also sitting at 59.2%, which indicates it's still in a seller's market. You really want the sale to list ratio to be in the sub 15 range for substantial periods of time, so at least 2 quarters, I would say, to indicate you're now in the buyer's market. So Ottawa is still very far from it. Now, because Ottawa don't have a lot of stats, so let's move forward and then look at Vancouver. Looking at the prices, we can see the price actually trend upward for the first 4 months of 2022, even though interest rates were going up and inventory were building up. Only in May did we see an average price reverse slightly. Do keep in mind again, this could be skewed by the size of the properties being sold at that time, so don't take this drop as a sign of actual adjustment. However, what we can say definitely is that sale to list ratio drastically dropped, especially for the detached. Typically, like I said already, a sustained period of 12% or under this ratio will have massive downward pressure on prices, while 20 or higher should have neutral or upward prices on price. And if we head over to ZLT and check on price per square footage, Vancouver itself still shows a steady price overall. There might be some adjustment month to month, but we don't really see a drastic adjustments yet. But if we go further away and look at specific regions like Langley or even Maple Ridge, we can see a much more significant adjustments there. So again, basically a mirror image of what we're seeing in Toronto right now. So moving on, let's talk about Montreal. Now here I only use Centris usually, but because they only do quarterly stats, we will be 2 months behind, which makes the stat kind of pointless. So what I did instead was went on Wowware and I found some stats on there instead. Transaction is down across all property types as expected. A little adjustments in median price for condo and detached. Semi-detached see a much more modest adjustment based on the sales prices. So in conclusion, we're seeing similar picture across all of Canada. Inventory is building, some are slower than the other places, but they're building nevertheless. Now, because we're seeing adjustments happening across all cities, I have been getting more and more questions from subscribers or even clients asking, hey, should I start looking for properties probably right now? And try to get something maybe in the next 3 months. Now, typically in normal times, usually my answers would be, you should buy whenever you're ready. But with the current environment, I would say you can still buy if you're ready, if it's for your own use. But the definition of being ready should be a lot harsher compared to the usual times. So here you need to be extremely careful and do tons of budgeting. And I would say add 2% on top of whatever interest rate you're expected to pay today, just to see where you are at cash flow wise. And also in terms of emergency cash, to be ready, if you're single or young couple, you probably should have at least 3 to 6 months of emergency cash ready in your saving account. If you have kids, I would bump that number up to 6 to 12 months just to be safe. And the major reason I'm talking about here is the death cross timing that we're going into right now for housing market, and it has something to do with affordability. Just because we're seeing price being adjusted downward, it doesn't mean that affordability actually improved for the last 6 months. In fact, it actually got a lot worse. And the reason why is because the price of properties being adjusted, especially city core, is too slow versus the rate hikes we're experiencing and expecting in the future. Now, I thought the best way to illustrate this affordability issue and why it's getting worse is by looking at an article on House Hunt Victoria written by Leo Spalterhaus. Now, I hope I didn't butcher your name, Leo. If I did, let me know in the comment down below if you're watching. I'm very sorry if I butchered it. Now, even though his stats is more for Victoria, because of how similar the real estate situation is for all major cities in Canada right now, I would say this article is very applicable regardless. So in here, he used Victoria sales price for house, townhome, and condo versus percentage of average household income, and assuming a 20% down and an average fixed rate. As you can see, affordability is a lot worse, even worse than 2021 during the FOMO bidding period, if we look at the mortgage payment and how much percent on average it takes up your paychecks. However, even though affordability is worsened, condo and townhome actually stay within their historical range. It is the detached house that is approaching 1980s level of affordability. So what happens if things got way too unaffordable, like even the wealthy people is unwilling to fork out the price or take on this mortgage at such a high percentage and pay for this house? Well, the last buyer will officially become the back holder and the market will correct. So Leo at the second half of his article also addressed this issue by looking at the historical data in Victoria. He plotted the affordability relative to its long-term trend along with price changes. As we can see, when affordability is 5 to 10% worse than normal, for example in the 90s and late 2000s, prices flatten or decline a bit. When affordability is much worse like the 1980s, where it is 25 to 30% above the normal range, price crashed. So where are we right now? In Victoria, condo affordability seemed to be at the same level as when prices flatten or decline a bit at the last 2 cycles. On the other hand, houses are closer to the 1980s price crash level. Now, in order to get to the 1980s level to be that affordable, Leo did say that he expect another 2 to 3% increase in interest rate and it would get us there, which I would also agree with this figure. Now keep in mind, again, the number is for Victoria. However, I feel like it's very applicable to other major cities in terms of affordability and where they're going right now. Which brings us back to my initial take on why currently it may not be a good time to look, is because of this death cross period we're entering right now. Unless you're doing all cash, or like I mentioned, you have done enough budgeting to factor in even the worst rate hike we can expect. If you don't prepare well right now and you just go out there and look, you may find yourself in a situation where rates are going up much faster than house prices can adjust. And suddenly, if you're doing variable rate or your completion date is much further down the road and you can't really lock in a rate until it's 90 to 120 days before completion, you may find yourself cash flow wise very pinched, and you can't even sell because your properties have been losing value steadily over time, and even if you sell it at a loss, you don't have enough to pay back your bank completely. So here, if you're not feeling 120% certain about your finances, or if you have a spouse with dual income and one of your job is not completely recession proof, I would say you should probably slow down a little bit and wait for the next 2 hikes, which now we expect to be 0.75 for the next one, and maybe another 0.5 or 0.75 for the one after. Now, another bonus point on why you should wait a little bit is you probably have some of your down payment invested from before, and given the current market, it's probably down already. So if you give it a little bit of time, maybe the next 6 months, by the end of the year, if the market does recover, then you could probably recoup a little bit and don't need to sell at such a massive loss. Alright, so that's my update and my take on the real estate market. If you like everything I'm saying today, hit the like button once. If you don't like them, make sure you hit the dislike button twice. Next one I want to hear from you is, what do you think about the real estate market around you? Are you seeing major adjustments? And also, if you were going to buy something, are you still going to buy it now, or are you going to delay and wait a little bit? Let me know all of that in the comment down below. And finally, if you like these kind of videos, I do upload them 8:30 EST, so make sure you subscribe to the channel and also click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!